certainly a tough time for income investors with yields globally falling. Over the last 10 years, we've seen central banks be very accommodative, which has impacted yields across the globe. On the other hand, we've seen expenses, the standard of living increase for most investors. So we've seen our clients move into higher yielding assets of the fixed income markets, which is obviously more risky. Yeah, the second half of 2019, our view is that global growth is going to remain sturdy. So we see global growth around 3% for 2019. Within that, we see the US slowing. Obviously, the US did pretty well last year with about 3 to 4% in terms of GDP. We see the slowing as physical stimulus does weigh off. In Europe and China, we've seen a stabilization in growth. Mainly from the stimulus that we've seen from the Chinese. So we do see a stabilization in growth from China. With this, we see central banks being a little bit more accommodative. So we've seen the Fed announce that they're going to be cutting rates potentially at the end of July. We've seen the ECB also state that they're going to be accommodative and potentially restart QE. So our view is that growth is going to remain sturdy, inflation still remains low across the board, and central banks are going to be accommodative. Yes, with global growth being sturdy, inflation remaining pretty low, and then also with central banks being accommodative, we do see sectors such as corporate bonds, emerging markets, structured credit being the best place to be for the rest of the year. We do believe there's some risks with the trade war between the US and China, but over the long term, we do see positive returns coming from spread sectors over high quality treasuries. Yeah, one of the key issues retirement investors face obviously is the lack of income globally. We've seen negative yields in Europe, and actually some emerging market countries do have negative yields like Poland. So it's a tough environment to get decent income into your portfolio. On the other hand, we've also seen complexity in terms of how some products are managed to try and increase the return potential. My advice is try and understand what the portfolio does. The more complex it is, there are probably some risks that you don't understand about. So complexity in funds is another one. And then finally, the costs. We've seen costs rise because of the complexity, some clients moving into more illiquid assets. That's creating some issues for our clients. Here at Legg Mason, we do have a product, which is the Legg Mason Western Asset Retirement Income Bond Fund, which tries to deliver simplicity in terms of how it's managed. It tries to deliver liquidity in a low-cost vehicle as well.